Earlier this week, it was reported that Canada lost 84,000 jobs, and now an oil blockade through the Strait of Hormuz is about to make that worse. Good evening, I'm Steve, and this is the Daily Brief Canadian Macro. Today, we're connecting some major dots that directly affect your wallet, your mortgage, and your job. We've got a job crisis deepening faster than anyone expected, bond markets flashing warning signs on rates, a commodity shift not seen since 2008, an oil shock that's already causing fuel shortages across Asia, and a look at Canada's gambling epidemic. Today we heard from Mania, David Lin, Eurodollar University, and Blueprint Financial. Let's get into it. Mania focused on the bond market signals building underneath that jobs number, and they're not pointing in the same direction. While the jobs report screams slowdown, bond markets are actually pricing in rate hikes. After Dollarama's earnings miss erased a full year of stock gains in a single day after forecasting 2027 sales below expectations, Market Mania's thesis is that this is a warning sign that even discount retail is cracking under economic stress. Here's why that matters for you. 6-month bond rates are up 21 basis points since late February, and 1-year rates are up over 40 basis points, the equivalent of roughly 2 Bank of Canada rate hikes already being priced in. If you're one of the 150,000 Canadians that banking regulators warn will struggle to refinance over the next 2 years because home values have dropped and rates are rising, this is a direct threat to your monthly payment. The bond market and the jobs market are telling two different stories right now, and the Bank of Canada has to decide which one to believe. David Lin zoomed out to the bigger picture. His argument is we're at the start of a commodity supercycle, the kind of multi-year shift that last happened in 2008. The commodities to S&P 500 ratio has reversed direction for the first time since then. His core point is that oil infrastructure damage in the Middle East will take 3 to 5 years to rebuild, and that rising commodity prices will filter through to insurance, groceries, and gas for years, not months. For Canadians, there's a split here. Alberta and Saskatchewan are being upgraded by economists, with WTI oil prices hitting 95 to 100 US dollars a barrel and pipeline capacity available to move extra barrels. But for Ontario and Quebec, already dealing with soft manufacturing and US tariff exposure, rising energy costs are another headwind on top of an already weak outlook. Forget a tale of two cities. Canada is a tale of two countries right now economically. Eurodollar University documented the human cost of the Strait of Hormuz blockade already playing out in Asia. The Philippines has declared a national emergency, importing 98% of its oil from the Gulf, with prices doubling since the conflict began February 28th. Australia had 600 gas stations run dry across its two most populous states, and airlines across Asia are preparing for fuel rationing. Their key argument: this shock creates recession through job losses, not inflation. Businesses absorb higher energy costs by cutting employees, not raising prices. We're already seeing that dynamic in Canada. TD Economics flagged that Canada's macro backdrop was already soft before the oil shock hit, and that the risk now is cost push inflation spreading beyond energy, while a weak labor market limits the Bank of Canada's options. Even if the strait reopens tomorrow, it'll take weeks to months before normal supply is restored. The damage is already in the pipeline. While Blueprint Financial took on a domestic issue that doesn't get enough macro attention, Canada's gambling epidemic, and it's not as disconnected from today's other themes as it might seem. There's a well-documented pattern that when economies weaken, gambling goes up. People locked out of conventional paths to financial security, such as stable jobs, affordable housing, manageable debt, start taking bigger risks to try to close the gap on their own personal balance sheets. The desperation becomes the connection. Blueprint Financial points out that the line between investing and gambling is being deliberately blurred by financial platforms, by governments, and by the design of products like zero-day options. Problem gamblers have jumped from 2% to 9.1% of all participants since sports betting was legalized in Canada. Ontario, for example, has collected over $800 million in gambling tax revenue in 2024, while simultaneously running anti-addiction campaigns. The macro relevance? This is household balance sheet damage hiding in plain sight. At a time when 150,000 Canadians face mortgage renewal stress and job losses are mounting, the households most likely to turn to gambling are the ones least able to absorb the losses. Online gamblers are 45 times more likely to develop problem gambling than lottery players. That's not a personal finance footnote, it's a systemic risk to consumer spending, and it tends to get worse before it gets better in an economic downturn. Here's the thread connecting all four stories today, and it starts with something we covered earlier this week. Canada shed 84,000 jobs in February, one of the worst reports in 4 years. That number wasn't just a headline, it's the foundation underneath everything we heard today. Market Mania's bond market warnings and David Lin's commodity supercycle both point toward higher costs ahead. Eurodollar University's thesis that oil shocks kill jobs before they spike inflation is something we're arguably already living through here at home. And Blueprint Financial's gambling data is a reminder that household balance sheets were already under stress before any of this hit. The one genuine bright spot, if you're in Alberta or Saskatchewan, elevated oil prices are a real tailwind, and today's macro story looks very different for you. But for most Canadians in Ontario, Quebec, and BC, these pressures are converging at the same time. Costs up, jobs down, mortgage renewals looming. The Bank of Canada faces an almost impossible call. Bond markets want hikes, but the labor market is screaming for relief. And with no resolution to the Middle East conflict in sight, that tension isn't going away anytime soon. Well, that's today's brief. All credit goes to the creators featured today. Their original videos are linked in the description below, and I encourage you to check out their full analysis. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.